Apologies to the people who are on Zoom. We're having a few technical difficulties. We'll get started as soon as we can.
Sure. If we can't see the screen or anything that's being shown, can you just let us know so we can follow it based on the attachments you sent that Robert sent us?
Yes.
Thanks.
Down into the Zoom. If we just.
Okay.
We're.
We're
Okay.
I'm getting a big echo.
There you go. Hello? Yeah. Got it.
I'd like to call the meeting of the Audit and Finance Committee to order. Robert, would you please do a roll call?
Yes. Chair Walker.
Here.
Member Sleeth.
Here.
Member Patel.
Here.
Member Skolnick. And Vice Chair Hill. I see you.
Well, I'm here, but
You're right.
I don't think I have an excused absence.
And I see we have at least one guest, Steve Berkeley. Welcome. I can't see if
Thank you.
anyone else. Right. So I guess before we go into our business, are there any public comments at this time? If not, let's move to review and hopefully approve the minutes of July 11th. The only addition I had is on the second page. We probably should add that well, it's kind of moot now, but the date of the next meeting should have said September 19th at 2 p.m., but we're all here, so I'm not going to worry about that. Any other comments on the minutes? Can I have a move to approve? From the room? Okay, Kate moved to approve. A second?
Seconded.
Thank you, Wally. All in favor, say aye. Aye.
Aye.
Any opposed? Okay, motion carries unanimously to approve the minutes as written. Next, we have a presentation from Gov Invest and, oops, no, selection. I'm looking at the minutes, sorry. I mixed up the agenda with the minutes. Okay, here we go. Next, we have a presentation by Gov Invest, and we're very pleased to have their representative with us. And for some reason, her name is not in front of me. Could you introduce her, please?
Thank you. Thank you, Chair. Yeah, we have Evie Laxana, Evie Laxana and Michael Melendrez from GovInvest Actuary are here to present our roll forward. But real quick, I want to just do a quick introduction. You have your staff report before you. Back in last year, September 2013-22 Finance Committee meeting, the committee reviewed and discussed the Town of Atherton Actuarial Value Report of OPEB for fiscal year ending June 30th, 2020. Again, these are benefits that the employees are eligible for retiree health medical. It was discussed that the new OPEB valuation report as of June 30th, 2022 had a positive balance of 93,344. So it demonstrated that the net position was 7.8 million to liabilities of 7.7 million, resulting in $93,000 income or asset. to the OPEB actual report. As a result, at our November meeting following subsequently, the Finance Committee met and considered and discussed the Atherton OPEB liabilities. After discussion, a recommendation was made to the City Council to begin funding 100% of the yearly OPEB benefits using the PARS trust funds. The City Council approved the recommendation of funding the retiree health benefits from the trust rather than budgeted operational expenditures. And so this brings us here to today. Today's review is based on the roll forward of that OPEB valuation report ending as of June 30th, 2022. The reason for it is we're meeting our actuarial requirements under GASB 75. And the roll forward is just an update of the assets and liabilities measured as of June 30th, 2023 for use in our current financial disclosure. So without further ado, I'd like to turn it over to Chief OPEB Actuary Abby Oksana and also Michael Melendres to discuss the report. Everything else in the staff report will be discussed in the presentation. And real quick, the discussion is going to include the funding of the town OPEB liabilities, the net position, and what it looks for in the future for our OPEB trust funds. Without further ado, turn it over to
Robert,
Abby.
I have a comment question that I'd like to make just before here. It seems to me,
Make sure your mic's open.
it's supposed to be red or it's supposed to be?
Green.
It is
Move
green.
it closer to you so we can.
Can you hear me now?
Yes,
Okay.
thank you.
I said I had a comment question with regard to the report here. It seems to me that basing this on a June 30th, 2022, when it's now September 2023, is an overly long wait. Where am I wrong?
Well, every 2 years, we have to do an actuarial evaluation report. We did one last year as of June 30th, 2022, so it's good for 2 years. We're going to do a new updated actuarial report at fiscal year ending 2023-24. So at the end of June 2024, we'll do a new actuarial report update of everything, the census, all the retiree health. But this is just a roll forward to see what happened from the 1 year ending June 30th, 2022 to fiscal year ending June 30th, 23. So this is a roll forward refresh. Again, next year we'll do a
What
full
you're saying
report.
is this is standard practice.
Correct.
Okay.
Correct. Any other questions?
I apologize
Oh.
to the presenter.
Oh, you're good.
Oh, you're fine. Can you guys hear me okay?
Yes.
Yes.
Okay. So, good afternoon. I'm here to present the results of the June 30th, 22 OPEB evaluation with the roll forward to 2023. Like Robert mentioned, the town is only required to do a full valuation every other year. It's really more to ease the burden on any employers who are required to do a full valuation, because in a full valuation year, we typically request the census data and quite a few additional information, and that can take up a little bit of time. So instead of having to do that every year, Gatsby allows all agencies to basically do it every other year. But obviously, the town is required to issue a financial statement every year. And that's why in the year when we don't do a full valuation, we just do what we call a roll forward procedure to the valuation completed last year. So what we typically look at during the roll forward year is that we do not update the census data. So the census data used for this year's report is based on the census data as of 6/30/22. So any demographic changes since then, unless it is significant, it is not going to be reflected in the roll forward report. We do look at the premium rates, what happened since 2022 and 2023 and 2024 if we know them, and we will reflect them in the roll forward report. Additionally, we also look at the expected asset return, whether that has changed since last year, and we will update the expected asset return as needed. So going to the presentation itself, can I have the next slide? Let's go to the next slide. One more. Okay. So I'm not entirely sure whether you all are familiar with the OPEB. The OPEB stands for Other Post-Employment Benefits. So it's basically any other benefits that you provide to your employees at retirement that is not a pension. So you provided retiree health benefits to employees at retirement. So the liability for this benefit is included in this report. The report does not include any pension liability or any other kind of liability such as severance pay. Next slide, please. So going to the OPEB valuation component. So OPEB valuation is really just a long-term cash flow of the liability of the cash payments that is due to the participants starting at retirement. Because it is a very long-term cash flow projections, there are numerous assumptions that we have to use in the valuation. So there are four main components to an OPEB valuation. The first one is obviously the benefit provision. So we need to know, how do you define retirement? When do active employees eligible to receive these benefits when they commence retirement? So how do you define retirement? It's number one. And then number two, we obviously have to know what kind of benefit is offered, whether you offer just medical prescription drug or do you offer dental, vision, life insurance, etc. And then we need to know how much does the town is going to pay for the retiree health benefits. So that's the benefit provision. That's the benefit that we are valuing the liability for. As far as the assumptions can be grouped into three big buckets. The first one is healthcare assumption. So just because you offer this benefit at retirement, it does not mean that all employees will take it when they retire. So there is an election assumption that we make in the valuation. Additionally, there are numerous health plans offered under CalPERS. So we make an assumption as to what plan will an employee elect at retirement. And of course, we're talking about a health plan. So the premium rates is expected to increase in the future. So there is an assumption as to how quickly the premium rates will increase in the future. So that is the first bucket of assumption. The second bucket of assumption is the economic assumption, because this is long-term future cash flow projections, and we are required to measure the liability as of a specific date, which is 6/30/23 in this case. We need to discount all the future cash flow to a present value basis. And the rate that we are used for discounting it is called a discount rate. And currently we are using 6%. And that is actually based on the expected long-term asset return under PARS. I believe you are in PARS. Yeah, under PARS moderate investment objective. And the last bucket of assumption is the demographic assumptions. So we obviously have retirees and there's a probability of them passing away in the future. So one assumption is mortality. So both active employees and retirees are subject to mortality assumption. Additionally, for active employees, they are also subject to what we call a termination decrement. So all active employees, not all of them are expected to make it to retirement. Some of them may terminate prior to retirement. So there is a termination assumption built into the valuation. Some employees may become disabled during the course of employment. So there's a disability rate built into the valuation. Additionally, once somebody is eligible to retire, all of them are not going to retire at the same time. It will be at different ages. So we do have retirement rates that vary based on age once an employee is eligible to retire. So those
I
are
ask-
the four components of the evaluation. Are there any questions?
Yes, something I noticed when I was going through the report is that I believe you're also making an assumption about the rate of inflation. I think you used 2.5%, which seemed low to me, but shouldn't that be under economic assumptions?
So the rate of inflation is actually it's a subset of the discount rate. So the discount rate includes the rate of inflation. So it's the healthcare trend rates assumption.
Got
So
it.
it is
Thank you.
not explicitly separated, but it is part of the other assumptions that we are making.
I guess at some point when it's the right time, I would love to hear you address where the 2.5% comes from, because I'm not sure that makes sense to me.
So the inflation rate, it is not like what you are seeing in the news as far as inflation goes. It is more a long-term view because we are doing a long-term cash flow projections. So yes, we are seeing higher inflation currently, but they are not expected to be sustained at that level in the long term, which is why the rate is not as high as what it is currently. So a lot of the assumptions that go into this valuation has a long-term view and an expectation built into it, as opposed to short-term fluctuations. And that is also meant to help so that the liability doesn't fluctuate wildly from 1 year to another, just because of like maybe shocks in the market or certain events like when COVID happened. We do not reflect like maximum increase in the healthcare cost expected once all the country is opening back up. So there are moderation built into the valuation because cash flow is expected to last many years into the future.
Okay, thank you. That makes sense. Do you happen to have any historical data for like 10, 20, 30 years of what the inflation rate has actually been on average?
I do not have the general inflation. The ones that I'm keeping track is actually the medical inflation. And the medical inflation is just usually is about 1 to 2% higher than the rate of the general inflation. So what we are seeing for medical inflation currently, going back to like 30, 40 years, is about 3%. So you would expect, the inflation is just going to be slightly lower than the medical inflation.
Okay, thanks.
Any other questions? Okay, hearing none, we can move on. Probably next 2 slides. Okay, so this is just a summary of the valuation results for the most recent 3 years only. Longer historical information can be found in the report. But as Robert mentioned, last year there's a net OPEB asset of just slightly under 100,000. So last year you were at 101.2% funded ratio wise, so you are slightly overfunded. And this year, with the slight increase in the liability, but better asset performance compared to last year, the funded ratio has increased to about 105.4%. So the town currently has a net OPEB asset of about 427%. So the increase historically, it has been positive, meaning that the town is seeing a gradual increase in the funded ratio, and now you are basically just slightly overfunded. And the one at the bottom, the actuarially determined contribution section, it is showing what we are recommending that the town contributes. Although there is no requirement for the town to contribute, it looks like in the past the town has historically contribute somewhere around the ADC. So we have shown the ADC amount just for comparison purposes, and also an expectation as to what the town can contribute in the future if you would like to do so. Questions?
Is there anything negative about being overfunded?
It does in a way that you may be putting in money that is not necessarily needed to a plan. And once you contribute the money to an OPEB trust, you are earmarking it for retiree health benefits only. So it is more like the opportunity cost that you are dealing with. like the money that may be able to be used somewhere else currently is essentially going to be tied up to retiree health benefit expenses. You cannot take out the money for any other purposes other than payment of retiree healthcare once you've contributed to the OPEB trust.
That makes sense. So ideally, every year we would be exactly 100% funded, right? Which is impossible to do. but-
Right, right.
Okay,
You do
got it.
not have to be exactly at 100%. So like fluctuation between like 90 to 110%, I think is fine. It is just when you start going to like 120% or 130%, then it almost seems like, okay, this is way too much money in the OPEB trust that you need to start using it.
Rick?
Yeah, but if you are over 100% funded as we are, wouldn't it then be intelligent to reduce the expected contribution to less than what would otherwise be recommended in order to bring us down to not being over 100% funded?
So when we do evaluation, we provided what we call the ADC. And the ADC, I know on the slide we are showing the 22-23 ADC, but the report itself, I believe, shows, let me flip to that page. The report shows the 23-24 and 24-25 ADC. So we provided what the look forward ADC is expected to be for budgeting purposes. And any overfunding that we are seeing currently is going to be reflected in the ADC calculation. Because the way it works, the ADC, maybe we can flip down to maybe page 10 or so on the presentation. Can I have a slide 11 on the presentation, please? One more.
Also, Tom, did you have a question? Tom Hill?
I did. I think it's along the same lines as what Rick just asked. But my understanding is in fiscal 23, we stopped making contributions. And yet you show 142,000 ADC. So I'm just trying to understand why it's 142, why, and how does the fact that we stopped making contributions affect all these calculations?
Yes.
Can I say
So the way the ADC works, there are two components to the ADC. One is the normal cost and the other one is the unfunded liability amortization payment. So when you are overfunded, the unfunded actual liability amortization payment, the orange part, that number goes to negative because you are now having more asset than liabilities, so you are amortizing a negative number.
Right.
However, you still have the normal cost. So the normal cost is what we call the cost of providing this benefit to your active employees and the fact that you are still offering this benefit to active employees. So as active employees earn one more year of service and they're getting one more year closer to retirement, there is a cost to that. And the cost for the coming year is called the normal cost. So you will always have the normal cost for your current active employees. But if you are overfunded, the normal cost is reduced slightly by a negative amortization. So you do still have an ADC, but it is smaller than if you have an underfunded plan.
Okay, and the intention would be for us to actually pay this ADC, is that right? Because I thought last year we didn't pay anything. Maybe I could be wrong about that, though.
Can I acknowledge Bob Polito, who's here in the room?
Robert, you made the ADC payment last year, correct?
Correct. We made the ADC payment, and what Evie was mentioning earlier, the ADC is listed, but it's recommended to make the payment, but we do not have to make the payment going forward.
So in theory, when you make the ADC, I sound very loud, you're paying for benefits earned that year. But when the investment returns of our trust fund are this positive, the real decision that the finance committee, I think, should be making is whether or not we should make the $119,709 payment in 2024 or skip the payment altogether. I would recommend we skip the payment given our overfunded status, which you guys have both mentioned already.
So I would still like to know, what did we skip last year? What did we skip in fiscal 23?
We didn't skip the ADC payment. We started paying all the benefits directly from the trust as
Oh, right.
Yes,
I got
correct.
it. Yes.
Correct.
So 4
Thank you.
months of the fiscal year, we paid benefits out of the trust. But the amount of benefits we paid obviously didn't reduce the trust. The trust is up 400 grand. So I would think we could skip the ADC this year, and then next year we'll have a fresh evaluation. That's not a roll forward, it's actual and detailed. And we can decide year by year whether to make the ADC, pay it 100%, or what needs to be done. But I think it would be foolish to make it this year.
Thank you, Mr. Pulido.
Thank you. I think that's a very good point. Can we finish the presentation and come back to that as an action item? Okay, please continue, Evie. Thank you.
Evie, do you want us to go back to slide 8?
Yes, please. If we can go back to slide 8.
That's the actuary notes. It's just going slow. There you go.
Yep. Okay. So because we do not do a refresh on the census data, like I mentioned earlier, the only assumption change that we are making is on we look at what actually happened to the premium rates from 23 to 20. So the premium rates, what we are expecting based on our assumption is that premium rates will increase by 6.5% for non-Medicare premium rates and by 5.4% for the Medicare premium rate. And I'm sure you have heard that CalPERS are experiencing double-digit premium increases from 23 to 24. So this time around, the premium rate adjustment, or what we call trend adjustment, caused a liability increase for the town because they are increasing more than what we expected them to. So we put a table on the slide. There are a lot of numbers, but the main point is that for majority of the plans, premium rates, the actual premium increases are higher than what we expect them to. And that caused a liability increase, which we can see on the next slide. Okay, so on the liability side, we were at 7.7 million last year, and it is projected to decrease slightly to 7.67 million as of 6/30/23, and this is just basically due to passage of time. Because the premium rates are increasing more than we expect them to, the trend adjustment, the healthcare cost experience added 224,000 to the expected liability. So we ended up at about 7.9 million as of the end of the year. Those are compared to the expected 7.67 million. So that is on the liability side. On the asset side, we are at 7.8 million as of 6/30/22. We are expecting the town to contribute 143,000, which is the ADC for the 22/23 fiscal year. With an expected investment income of 6%, the asset is expected to end at about 8.4 million. Now, what actually happened is at the bottom, 7.8 million, the town contributed 627,000, whether it be a contribution made to the trust or contribution made from general asset. And then there's the benefit payments of 673,000. The actual investment income is slightly better than what we expected them to be. And the asset ended up at 8.3 million as of 6/30/23. So that's what actually happened on the liability on the asset side. So going to slide 10. Oh, that's your question.
Go back to the previous slide. So so you say the town made contributions of 627,000. It was my understanding that they didn't do that.
So the contribution is not necessarily contribution that is being paid into the trust. It includes any kind of payments being made from the general asset to pay for retiree health benefits. Those are considered contributions as well.
Yeah, but I thought that's what we just said was not done last year, that we stopped making contributions.
No,
Right.
We stopped paying for we stopped reimbursing the fund for actual expenses.
We didn't,
We stopped,
we didn't stop reimbursing till March.
correct.
So it was
Uh.
4 months. So for 8 months, we contributed what was necessary to pay the employee. You add that to the ADC and you get to the 627,000 in contributions.
Correct.
Okay,
We stopped
Is that-
contributing to the trust, but it doesn't mean that we stopped contributing to the retiree health. Whether it was us contributing to the trust directly or the trust making that contribution to the retiree health. Before we stopped making payments to the trust, we were doing the pay-as-you-go. So whatever we owed for that month, we paid to the trust, and that same amount went out of the trust. When we stopped contributing to the trust slowly started just funding the retiree health. So it was the two components, what we contributed, and then when we stopped, we were still paying the retiree health, but now it was coming out of the trust.
okay.
So I think what actually happened is for the 8 months of the
Mhm.
year, the town make contributions to the trust and then the trust pays the money out. So essentially it's just money in, money out.
Correct.
But for the last 4 months of the year, the town does not contribute anything. So there's no money in, but the trust still pays out the retiree health. So it's just money out for the last 4 months.
Okay,
Okay. So going to the next slide. So this is just a historical view of what happened to the unfunded liability and the funded ratio. As I mentioned, it has essentially grown positive, increasing in the funded ratio and decreasing on the unfunded liability. So this is the same story that we have seen in prior slides. So going to slide 11, which I think we can skip since we talked about this, going to slide 12. So this is historical view as to what contribution was being made to the trust and as well as benefit payments being made from the town's general asset. So for 2019 to 2023 to 2021, especially, the town has been making benefit payments from outside of the trust. So there is a little bit contributions being made to the trust, which is the greens. But 22 and the 23, it looks like the benefit payments are being made mostly from the trust, although maybe the towns do make contributions to the trust. So like again, it's just money in and money out. Now for 24, what we are recommending is that you contribute the 120,000 AGC and then let the trust pays for the benefit payments. So essentially the net cash flow from the trust is going to be negative. Barring like we are discounting what the trust will earn the actual investment income. So without the investment income, what is going to happen to the trust is that the town contributes 120,000 and then the trust will pay out the benefit payments, which is shown on the next page, I believe. And the benefit payments for 24 is expected to be somewhere around 550,000. So there will be a negative net cash flow from the trust in 24. But as you said, you know, and we have said that there's no requirement that you have to contribute the ADC. So this can certainly be a year-by-year decision on whether you want to make the contribution during that particular year. And then we'll just reevaluate and recalculate the ADC every time we produce a report. And any kind of underfunding or overfunding on the trust, it will be reflected in our recommended ADC. Any questions?
Just a summary statement, I guess. So when I went through the report before hearing your oral report, which is very helpful, thank you very much. I came away from it thinking, okay, let's go up to the 30,000 foot level. What is it? What does this all mean? And is there something we should change, or are we doing well? And I think I just heard you say that you're recommending this $119,709 contribution to kind of get us back closer to 100% funded instead of 105% funded. Is that a correct statement?
Yes, that is correct. So I'm recommending that you do not make any payments from your general asset. You pay the ADC contributed to the trust and let the trust pays for benefit payments.
Great, thank you. Oh, I guess.
That was the end. Go to the next slide, Anthony. Yeah, that was the question and answers. That's it.
So let me make sure that I'm not positive that I understand this, because Bob, when you said, let's not contribute to the trust, are we saying, you saying the same thing that she's saying?
No,
No, okay.
we're saying different things.
That's what I thought. So I want to understand what makes most sense.
I understand your point, but if you look, if you go back to slide 9,
Mhm.
going to make 0 contributions. She's estimating expenses in this coming fiscal year of 550,000, but our investment income was 533,000 last year. And it's mostly, correct me if I'm wrong, Robert, it's mostly invested in fixed income stuff where the interest rate is going up, not down.
It's in the report. It said not just all fixed income, but it's in a moderate
Well,
index.
Yeah, it's 45% fixed income and there is 48.25% in equity.
I didn't realize it was that high, but I guess at the 30,000 foot level, my point is, if you're estimating our expenses are going to be 550, and if our investment income this past year was 533, there's no reason to think it's going to be less necessarily. It could be, but there's no reason to think that. So we'll still be overfunded at the end of the year. If we're not, we'll have to maybe increase the well, you automatically will increase the ADC actuarially when you do the revision next year. But the numbers to me tell me that we're still going to be overfunded even if we don't make the ADC.
So I think it is important to not stress so much in trying to hit to the 100%, because it is going to be a moving target with the fact that, you know, we don't know what's going to happen to the market. We don't know what the investment income is. I think, you know, as long as you look at what the asset is doing, you don't have to make the ADC until like the last day of the fiscal year, like June 29th, you make that payment and that's totally fine. So you do have time to make a decision as to whether you want to make the ADC payment or not. And skipping 1 year of ADC payment is not going to make or break the plan. You may come in at 99%, it is not 100%, but you will still be fine.
Yeah, and we're always going to have that normal cost, whether how you had showed in the other slide that we have the unfunded liability is a positive because we're in a positive income, but we'll always have the normal cost for the present value for active employees. And that's what we have been doing is paying that ADC payment because we still had to pay that towards the liability every year. But like you mentioned, if we miss this 1 year and we wait till the end of the last day of the fiscal year and decide if we want to make the payment, but maybe next year when we do the full actuarial evaluation report, we can see if we go from 105% to maybe 101, or maybe we stay at 105. but that the normal costs will always be a part of the plan going forward.
Right, but I think what Bob was saying is that he believes that the income
Income,
to the
the interest,
trust
right.
will be pretty darn close to be able to cover that. Is that right, Bob? Sorry.
That's the plan.
Based on, well, based on the
Based on
information we
the
have
investment,
now.
correct.
So I guess I keep coming back. I'm waffling. I realize that. Do we have other inputs from the committee on what, because I'm tending.
Tom Hill
I
has
te-
his hand
sorry?
up. Mr. Hill has his hand
Oh,
up.
I'm so sorry. I can't see it. Tom, please.
A significant part of this total OPEB liability is what's called an implicit subsidy. I don't really understand it, but I think Bob Polito has said in the past that based on his understanding, this will never have to be paid. And so, already we're way conservative because we probably never will have to pay this OPEB liability. But Bob, could you talk about that? Because I'm just basing what I'm saying on what I understood you to say in the past.
Thank you for reminding me about explicit and implicit liabilities. You're right. If I remember correctly, the implicit liability was well over $1 million in the last calculation. So that's an extra buffer above and beyond our overfunding. Again, I can't think of any reason to make the ADC. And at the very worst, if we have horrible investment returns, we could make it late in the fiscal year, right before we start the next year. Thank you, Tom.
Any
Welcome.
other inputs?
Thank
Go
you.
ahead, Wally.
I still don't understand the difference between the explicit and implicit. Could someone more sophisticated than I am explain that to me?
You don't really want to understand it, but what
I can
What
try
I-
to explain. I can try to explain. So
Please
the
do.
explicit subsidy is basically what you promise to your retirees. So if you say that I'm going to pay 10% of the premium, for example, then it's basically 10% of whatever premium that CalPERS is telling you. So if the premium is $800, then the town is paying 10% of $800, which is $80. That's your explicit. That is what you explicitly promise to your retirees. Now the implicit comes into play because the $800 that CalPERS is telling you, it is based on blended active and retirees claims experience. Now, if you split your population into active employees and retirees, the active may cost $700, but your retirees may cost $900. So the difference between the 900 and the 800 is what we call the implicit. So it's basically the additional cost that you are being charged, you're not paying for it, it's charged because you have retirees in the plan because it drives up premium slightly for your active population.
I would explain it ever so slightly differently. The way I understood it was that if the town had to go out and get their own insurance, medical insurance for their retirees and not use the weight that CalPERS has, and because we have a quite elderly bunch of retirees, that our costs would be way, way, way higher, and that's what the implicit subsidy is. The reason I say it will never be realized is because CalPERS insurance is not going to go away, and we're not going to go somewhere else to get insurance. That would be some form of insanity to make that happen. So is that what I'm saying more or less correct?
That is correct. Keep in mind that the implicit subsidy is only generated for your non-Medicare retirees. Because for your Medicare retirees, the Medicare pays first. So there is no implicit subsidy because, when any insurance company calculate premium rates for the Medicare population, they only look at the claims for the Medicare population. It only exists for your active and non-Medicare population because of the cross subsidy between the two groups. But what you described is exactly right.
Yeah. So like Commander Wade, I think, was he a commander? I think he was a
Yes.
commander before. Yeah. So he left. He's non-Medicare. He's going to be on our books as non-Medicare for a long time.
Mhm.
What? Yeah, yeah. So that creates a lot of implicit
Yeah.
numbers.
And just for reference, in the report, the actuarial report, page 7 shows the breakdown of what's explicit and the implicit on the liability. So for the implicit and again, it's on page 7, the active employees make up, the implicit is 237,000. And for the retired employees, it's 850,000. So the implicit subsidy of that 7.8 million is about 1,087,000. And again, that's on page 7. And then page 20, correct, of the report. And then page 21, which is section 5, shows page 22 of after the actuarial determined contribution shows the contribution of the health benefits, what is explicit and what's implicit. So for 2024 in page 22, the total amount of employee projected benefits paid is 558,000. Of that amount, 98,000 is the implicit, 460,000 is the explicit.
Are there any other comments or questions from members of the committee? Robert, you're our staff person. What would you recommend before I bring this to a vote?
We could make a recommendation that maybe we review to see how the trust is doing as far as the investment, and then see if maybe towards the end of the year, we can make a renovation out now for towards the end of the year, review to see if we're going to make the ADC payment for fiscal year 23-24.
Bob, does that make sense to you? Okay.
Yeah, we can do we'll do the May Finance Committee meeting in May 2024, when we have a meeting. We'll bring that, we'll see where we're at as far as the trust, how we're doing as far as investments.
Yeah.
And then we can make the recommendation. Do we make the ADC payment of 120,000 for the year, or we don't?
Okay, then I'm gonna move that we recommend to the council that they not make the ADC payment at the present time, and that this committee reevaluate the position of the trust and liabilities at our May meeting, and make a recommendation whether to stick with that or whether at that time we should consider making some additional payment. Is there a second to that, or any discussion, further discussion? Kate, second. I guess we should roll call.
Yeah.
All
roll
in
call
favor?
vote. Let's do a roll call vote. And remember,
They can't
those
vote
that are
Zoom.
online cannot vote.
Okay,
So Chair Walker,
yes.
Member Sleeth, sorry.
He votes
Yes. Member Kate Skolnick, yes. Okay.
Okay, so we have all in favor, so the motion is passed. Yes, sir. Thank you, and thank you for that recommendation, Bob.
I was going to recommend that you have a contingency in the event that the finance committee doesn't meet in May, because right now it's conditioned on your meeting. And if you don't meet, it would be good to have a standby subcommittee that you could delegate that authority to. I think there has to be a recommendation to the council, but that can certainly be done. The thing that would be a problem is if you don't meet. Let's say you don't have a quorum.
That's a good point. And so we can't appoint a subcommittee, can we? The
Yeah.
council, we can?
You could have a subcommittee of only 2.
Right?
Too.
And how Councilmember DeGoya is mentioning, the subcommittee can maybe convene if we don't have a meeting in May.
Right, okay.
So
Well, then I guess I'll make another motion that we appoint a subcommittee of 2 members to meet if there is no meeting of the audit committee, in order to take the actions, recommend the actions to the council that we have just discussed, and the question is who should be, I think I should be on it since I'm chair. Is there anyone else who would like to be on it? Tom Hill, would you be willing to be the other member of that subcommittee?
Sure.
Absolutely. Okay, so I made the motion. Somebody want to second that motion? Kate seconds it. All in favor in the room? Aye.
Okay.
Okay, unanimously passed.
Okay.
And Robert, I'll work with you so we can get them.
They can't vote anyway.
It-
That they're not exempt, they're not exempt.
And we have to list their address where they're at. It's going back to the old Brown Act rules of meetings. So, okay.
Okay.
Yeah,
Wow, I think that's more action that we've taken in a year.
Right.
Okay, so are there any other questions or discussion for our guests before we move on to the next item? Thank you very much for the presentation and for entertaining all of our questions. It's been extremely helpful. And we'll see you next year, if not before.
Sure. Thank you.
Thank you.
Have a good one.
Thank you. Thank you, Michael. We'll be in touch. Appreciate it.
Thank
Thank
you.
for all your work.
Bye.
Okay. So. All right, so our next item, item 3, is review and discussion of the CalPERS actuarial reports as of June 30, 2022, and general update on pension plans in preparation for a presentation by the CalPERS pension actuary. That's not happening today, right?
No,
This
it
is
is.
prep for the future.
It's prep for the future, and I've confirmed our actuary will attend our November meeting to discuss further these reports, what's transpired in the last couple of years with the plan asset allocation changes, with the discount rate changes, with our ADP payment that we made, and the outlook going forward. So confirmed with Julian Robinson, our actuary, will be here at our November meeting to further discuss these reports. So I wanted to get these reports to the committee for review. Just real quick, the preliminary rate of return for 22-23 was 5.8%. The previous year in 21-22 was negative 6.1%. So the 22-23 investment returns will be reflected in our rates starting in fiscal year 2025-26. The negative rate of return of 6.1% in 21-22 is reflective in our contribution rates and UAL payments for fiscal year 24-25, which are part of these actuarial reports that came out. So the way the actuarial reports come out, they come out, the report is as of fiscal year 2022, and the rates are created for the upcoming fiscal year. So we have what our 24-25 rates will be for normal cost and what our UAL payments will be. So those are listed in the reports, and I put them in the staff report for the committee to review. So the 24-25 normal cost percentage of payroll for the miscellaneous employees is 12.67%. The current rate in this current fiscal year 23-24 is 12.63%. So it's a 0.04% increase. The UL payment is projected at $532,000 in 24-25. It's currently, we paid the UAL payment of $431,000 in the 23-24 current fiscal year. We pay our UAL payments upfront as a lump sum. Agencies have the option to pay their UAL payments monthly in the current fiscal year. We always pay it upfront as a, it's always been where we pay it upfront, and those payments are due at the end of July. So we made our UAL payment for the whole year, and that was about $1 million that we paid. So on page 2 of the staff report is where I listed the miscellaneous current UAL payment that is projected in 24-25. Again, that's about $100,000 increase over our current year of our UAL payment that we just made. The safety contribution for 23-24 is currently 29.09%. The normal cost is projected in 24-25 to be 29.3%. This is on page 3 of your staff report. And the UAL payment is projected at $1,019,000 for 24-25. We currently paid $791,000 in fiscal year 23-24. So that's an increase roughly about $229,000 in UAL payment from current year to what we are expected to pay next year. So in total, the increase in the UAL from 23-24 to next year 24-25 in total is an increase of $329,000. So again, we'll have Julian Robinson here to kind of discuss these UAL payments, the normal cost, what they project that how they would go up in the next several fiscal years. Sorry, I want to go back and just kind of on page 2 of the staff report, I've kind of put in the net rate of return for the last couple years. So you can see this 22-23 was 5.8%. Year 2, which is 21-22, it was a negative 6.1. 3 years ago in fiscal year 2021, the rate of return was 21.3%. And then you can see 10 years, the net rate of return was 7.1%. At 20 year, it's 7%. And over 30 years, the rate of return on the plan is 7.5%. And then I put the asset class, so you can see for 22-23 how that came about for the total fund of 5.8%. The public equity was a positive 14.1%. Private equity was a negative 2.3%, and real asset negative 3.1%. Private debt 6.5%. So that is the what it was for this 22-23 ending rate of return.
So I have a couple of questions which are probably going to reveal my lack of knowledge, but I'm trying to figure out where is it that we can see the impact of the $5 million additional discretionary payment? Because I thought we were going to see these numbers coming down, and I'm seeing them going up. I'm seeing the contribution to unfunded liability going up. I'm seeing the value, the dollar value of what says the total unfunded liability is 19.1 million, up 3.9 million from last year's.
Correct.
So I don't get it. What happened to the $5 million?
No,
Am I missing something?
It's staggering.
Yeah. Well, and if I might make, of that 3.9 million, the increase of that 3.9 million, 2.5 million of the UAL increase is on the miscellaneous side.
Right.
The public safety side only went up 1.3 million. So it's not like we paid the 5 million and then we just lost completely. But the actuarial reports that were for the fiscal year ending for 6/30/21, which was the ones that were given out in March, those show for the public safety what that 5 million contribution did. And it shows where we eliminated the and what we did when we presented it to council and through the recommendation of CalPERS is we paid the oldest first down of the UAL. And so that's reflected not on these actual reports as of June 30th, 22. It's reflective in the actual reports of June 30th, 2021. We could see on the ADP of that 5 million payment. But I have confirmed, and I had mentioned to our to Julian that we would like to discuss that 5 million and see how that you know, what we did when we contributed, then that at the end of that fiscal year 21-22, because we made the payment in April of 2022, and then the
but that-
investment was a negative 6.1.
We're getting hit right now. The rates going forward are based on that year where the
Correct.
fund lost the 6%.
Correct.
And if you look at page 20 of either report, miscellaneous or police, the discount rate sensitivity, the
Mhm.
numbers are staggering.
Right.
I don't think I fully digested that in the past, but a 1% lower return rate for miscellaneous
Mhm.
can take the accrued liability from 21.5 million to 24.5 million.
Correct.
So investment returns are, I mean, they're unbelievable. The effect is unbelievable. And that's what we're seeing, right? in this report.
Mhm.
Now, the next report we get will reflect the 5.8% return.
Mhm.
So the numbers should be softer. And I guess in essence, the $5 million, when it gets allocated, so to speak, it's really spread over the lifetime that we're paying down the unfunded liability. So they said it was going to be, last year, they told us it would affect the next 5 years' payments by $1.7 million, I think.
Mhm.
It's in here
Correct.
somewhere. And in reality, because of the negative returns, among other things, it really only is only going to save us $1.5 million over 5 years.
Correct.
And the rest of it's in those out years.
Mhm. Yeah, on page 3 of that staff report on the bottom, I updated the UAL payment based off of these updated reports, and that is correct. As of June 30th, 2022, we're having a savings of 1.57 million, but the previous actuarial report of 2021, it showed an estimated savings of 2.68 million. And again, and the negative 6.1%, the CalPERS hadn't had that negative rate of return in the last 20 years, or since probably the recession started, not 20 years, almost 15 years now.
Yeah.
So,
2008.
I'm gonna go back to the statement I've made before, which is this whole CalPERS thing is just right out of Alice in Wonderland. And Alice said, I have to run as fast as I possibly can to keep from going backwards. And if I don't, I move backwards. And that's what's happening to us every year with CalPERS. Anyway, I think Tom has his hand up. Tom?
Well, I just wanted to say, I think the way to view this essentially is for all of fiscal 23, we had that $5 million in the fund. The fund earned 5.8%. So the $5 million earned 5.8%. And so the town is better off if the town had kept the 5 million instead of putting it in CalPERS. I'm sure it would have earned less than 5.8%. So from my point of view, it was a good decision.
I think that kind of answers my question. Robert, you mentioned that we paid in July some for.
That was the UAL for this 23-24
I
fiscal
was
year.
going to ask, what's the best way to measure the value of doing that?
Well, there is a savings. So we saved about $72,000 in paying the lump sum rather than paying it monthly. Some agencies do pay it monthly, but since I've been here, we've always paid it at the beginning of the year, at the beginning of the fiscal year.
Okay, thank you.
So.
Go ahead, Rick.
Thank you, Tom.
I mean, the thing that everyone should focus on is their assumption. Their assumption is every year, their assumption is that they're gonna make this in the 6.8% range. And they have done that, but they haven't done it often.
If you're looking at
The consequences are dire.
And if you look at the rate of returns over the time period, of 10 years, they've hit 7.1%. 20 years, 7%. Over 30 years, 7.5%. Not too long ago, back in 2012 or kind of long ago, the discount rate was 7.875. Then they gradually started reducing it. Then they reduced it to 7% back in 2017. And then we thought, okay, we're going to be good there. And then when they had the double digit return of 21.3%, they did the asset review, and then they reduced the discount rate to 6.8%. I don't think they're going to adjust it again. Every 4 years, they'll review that. But I think the 6.8 is hopefully we can get above that every year. But Councilmember DeBoy is correct. Yes, and I think you have a question?
No, I
I'm
just
sorry.
forgot to turn off my button.
Oh, okay.
Any other questions or comments on this debacle?
Well, it is. I mean, the numbers are staggering.
Yeah,
So,
it's,
I think one bright spot is where fixed income has moved.
Yeah.
I think that'll help CalPERS performance significantly. I don't know what the exact percentage they have in fixed income right now is, but, you know, those numbers have gone up fivefold, so.
so
Yeah.
are there any additional questions that the committee would like to have Robert Julian up with? That sounds like you're already gonna ask about the 5 million.
You're correct. The
$5
$5 million.
million question.
Then we could do probably an outlook, maybe do a scenario of, you know, what happens this current fiscal year? What if it's 6.8? What if it's, I mean, they have the, you know, the 1%, if it's 5.8% over 7.8% sensitivity, but see if we can do some scenarios with Julian as far as the pension plan. You know, we made a significant contribution. I think for budget wise, if we didn't make that 5 million contribution, we probably, our UAL payment would have been larger. I mean, you could see in the page 3 of the staff report, if it, what it was before we made the UAL payment and what it was after we made the UAL payment. Well, granted, yeah, we had the negative return. It's higher, but it's not as high as it probably would have been if we didn't make the 5 million UAL payment. Another thing is maybe to think forward is you know, we have a pension rate stabilization fund. We can set money aside just like we did with our PARS trust. You know, that's another you know, exercise for the future, you know, as far as once we get an understanding of what Mr. Robinson, you know, conveys and what the outlook is, maybe that's another exercise to seeing about setting money aside.
I think it's important, though, to keep track of the savings generated by that $5 million. So if this topic comes up again, we have the data to know how badly we got beat up.
Correct. And that's why I try to update it, showing that this is what we presented before. This is what it was, you know, in the other staff report, when we presented the actual 2021, we saw what the savings was. And then I just updated it based off of what this current one shows. And so, yeah, the UAL did go up for the public safety, but I agree. We'll keep track of the savings.
Yeah, I went to get last year's numbers so I could, I don't know where I put them. I mean, I know they're in one of my offices, but I don't know which one. I couldn't find them. I was otherwise occupied, maybe. I don't know.
So, Robert, we don't need to take any action.
There's no action.
Okay.
It's just information to have ahead of time for our presentation in November. And then we will have HDL reviewing our property tax to see what, also in November, to see how our current 23-24 property tax values are for Atherton. So Holocon's excited about that. So I'll have those 2 presentations.
Okay, that sounds good. I just.
An interesting tidbit that I got from my, you know, as being a neophyte on the planning commission, Sally, talking about trees, there are 104 active permits for construction in Atherton right now. Now, 104, and she says the issue was, could she police all the tree activity? And that's why she quoted that number. But just think about, from a property tax point of view, 104 of them, and probably the smallest house being built is probably 6,000 square feet. Some of them are 15,000 square feet.
Those are building permits. They could be an arbor. They could be.
You're right. They're not all new houses.
Correct,
That's correct.
correct.
But there's 104 active permits, which is a lot in a town with 2,200 or 24.
25 to 28 houses built a year in the town. Yeah. And that's been true for 4 or 5 years. So that's been quite consistent. We've been in that range.
And then how long they, correct. And then how long they take to build as well.
Well, that's a different issue. how long they take to build means that you could have permits outstanding that are, those are just 1 year. There are definitely houses that are taking more than 3 years to build.
Definitely.
So I think we're through all of our scheduled action items. I just wanted to solicit if there's any issues that you would like to see on a future agenda, because we can only talk about what we put on our agenda. So do any of the committee members have suggestions? If not now, certainly bring them to my attention or Robert's attention, and we'll try to accommodate them in the agenda. Steve, did you want to say something or? Okay, you're muted. Sorry, I thought I saw your hand.
Fine, I'm all as an outsider, I'm in favor of taking a look at that liability as it approaches their fiscal year end. Anything that we think we don't have to pay, where we could take a look at the asset size and see if it's going to be to our benefit just to not pay or to pay. That's a reasonable decision.
Thank you. So there's no other business to come before the meeting. I move to adjourn. Do I have a second? Thank you, Kate. I can count on you. All in favor? Aye. All right, the meeting is adjourned. Thank you, everyone.